Hey, good morning, guys. Ken at Tortoise Capital. This is the weekly check-in for Foundations Q&A. Um, May 23rd. No, I'm sorry. May 21st, 2023. Let's do just a quick check-in for guys that are here. Hamad, how are you doing?
Doing very well. Just enjoying my Sunday.
Good. Greg, what's up?
Good. Everything's good. Slow and steady. Yeah.
Cool. Damien, you doing all right?
I'm doing awesome. I'm making some progress, and I appreciate all your help, and not just you, for the whole team. Awesome support group. Love it.
Yeah. Yeah. Last week felt like a different week altogether for you.
Yes,
Um,
yes, and that's thanks to everybody that's pitching in to help each other, not just me, because we learn from each other, and it's awesome.
Yeah, I say that, but I don't want to. I don't want to poison the well. I don't want to jeopardize you, so I'm knocking on wood. All that. Marlon, how you doing?
Doing good, doing good. Just making progress. I think every week I am getting sort of a one or two new things, so that's good.
Good. And Rad, how we doing?
Oh, good. Can't wait for the next week to start trading again.
Yep. This is fun. All right, so we had one question today. Good and a good question. So as usual, it will take slightly more than an hour for me to answer it. If history is any indication. Let's see. All right, so Rad says, I want to simplify and deconstruct everything I do. And your interpretation of our strategy is that it's a game of probabilities. Yes, because math is a persistent edge. At the same time, dancing with the market while minimizing losses. So don't step on her toes. So there's a certain amount of art and performance in this. In some ways, math, if you let it, can become abstract. And we want to make sure that we are applying it in our art and performance. So you sent me two scenarios. One was perfect market conditions, perfect execution, unfavorable and good execution. So I struggle to correctly assess the market conditions. If that's the time and symbol I should be trading. Okay. One day I feel in the zone and catch many correct ones, and another day I scratch and turn losses one by one, then feel burned out and capitulate or just too tired, and then I see opportunities coming. So both of these examples are examples of clean market moves. So if we add noise, we can see how we could turn it into a 5-hour losing day. So the question is how to assess the situation, when to stop trading altogether, to wait for, wait for proper situation. When to wait for some unpredictable noise or blips. Yeah. So you're looking for me to tell you when to predict the unpredictable. Okay. And when aborting means losing opportunities, it always does. And after 5 scratches and losses totaling 2R, and here comes the next 2R comes. So there's a lot to unpack there. First of all, I like I like the idea of simplify and deconstructing, and those are two very different but important things. So one, simplify, is to use like a Pareto process, which says that 20% of the things that I do lead to 80% of my return. So 20% of my actions are going to lead to 80% of my returns. And that's true outside of trading and everywhere. You just don't know which 20% of them they are until after the chips are counted. And the reason is that they all look same. Leaving the station. And I'll come up here to this one. Do those look the same? I think so. This one, the river was down. The dragon was down. It was in the middle of the river. River was down. No, the river was flat on this one. The dragon was down. And this is in the middle of the river. Right exactly at the middle of the river to PSAR flip. So was this one. It moved slightly and exited. This one moved slightly more out past Z2 and exited for a scratch. So there are some similarities, but they're not identical. The next trade, this one broke the PSAR and scratched. This one broke the PSAR and gained, because if I look closely enough, if that's where the Z3 line was, that move actually went into this region below the previous Z3, whereas this one did not. If I were to interpolate that, this one made a move that went like approximately half the width of the river. That one went all the way down to here and then exited. So not identical. This one was a PSAR flip right in the middle of the river, so was that one. This one moved up to the Z3. This one did not, because you'll notice that the difference is that on this one, when the PSAR flipped happened, the Bollinger Bands were expanding. Why? Because the last move in this segment was a mover. It moved beyond the previous Z3 a certain distance, and that caused the Bollinger Bands next to expand, whereas this one stayed inside the river, and that actually caused the Bollinger Bands to narrow. So those are not identical moves. Now, the result was the same. This one scratched. This one actually had a slight win. Now this one, the PSAR flips. This one, the PSAR flips. This one moves outside the Z3, the width of from Z3 to Z3. This one gets to about Z2 and scratches. So if I were to extend the Z3 lines, this one never leaves the river. Now I want to note, just for scale, that the yellow box, are they the same size? It turns out, yes. Yeah, they are. Only because I drew them to scale. So the difference in these is that old number 2 here, this has this moment right here tells you is where it becomes different. This one says it's in play because you had to move outside of the Z3 lines after some long enough series. So that's about the first time I can say that this one is different than one. This one never moves outside the Z3 lines. This one moved out 1, then reverts back to the mean. So this blue line is simply bisecting that 30-cent box. It's 30 cents from here to there. And the symbol is about $45. This one I think was 46. This one was up around 49. But if we just said for 35, this is less than 1% of price. This target is soybeans. So that's the way soybeans move. Soybeans move to 0.6% of price is the channel. So that's hard. Now, why is that the case? Because it's a commodity that has a very narrow population of people that are trading it. Most of them, the volume of it, is in ag producers. And then there are some small number of traders who are trading the futures on them. These guys are all trading the futures too, but so that they can make something. These guys are just trading the oscillations because it's a market that moves. So acting purely as the middleman, these guys are acting as end users or producers. So the whole supply chain. But those are pretty narrow definitions, and you could expect those guys to be specialists in that. Now, I'm going to compare that to Tesla and marijuana, which are trading 6% of price. And the 30-cent box is about the same size. I mean, it's almost the same relationship now. When you look at, if I were to go look at Tesla, it moves differently than soybeans. So one of the things about assessing the market conditions is you got to look both at the current state and the long-term normal or steady state. Now, steady state doesn't mean that it's just moving sideways, but some things move with a certain rhythm, like a seasonality, like the way crops grow. And then if we're going to understand that market, then we can understand what are the sizes of peak to trough, and how long does it take so we have amplitude and frequency. And then how much does that vary? And if I take this as some kind of normal wave, is that thing if I go up 3 or 10 time frames, Is that thing in an oscillation like this? Is it in an oscillation like that? Is it an oscillation like that? What are the super cycles of it? So that's where we're using statistics to identify the norms. What is the range of normal behavior? So that when I see some period, I can say how normal was the last 150 bars. And then how normal was the last 30 bars. And now what is the tactical opportunity look like? That's horribly drawn, sorry. Let me do this correctly so that I'm using the same colors that you see on the market chart. So if I just think like a sniper, and that's going to be the way I'm going to try to simplify this. And the first thing I'm going to do, what I'm doing is deconstructing the market into pieces and segments and doing analytical thinking. How many moving pieces and parts and components are there? And then the next thing, simplify, is to do that Pareto 20-80 piece. What are the key and essential items? What's important? What are the signals that tell me if I'm normal versus abnormal? So I got to find out how unique and complex it is. So these are two different skills. So the first thing that I'm going to coach you on is I don't want you to treat those as if those words are identical. They're not. The first piece is I got this dang hairball of something, and I got to deconstruct it into what are the pieces and parts, the forces, the actors, what's the ecosystem composed of? And then how can I render that into a simplified model which gives me clarity at some cost, that I'm missing some of the fidelity. But if I can identify the things to focus on, that makes it simple. If I get the main pieces right, then the clarity comes at an affordable cost because I'm still getting most of the value. And that's the idea behind 20-80 thinking, is that in the Pareto principle, if I can focus on 20% of the information and get 80% of the value, then the cost is probably in my favor, that the simplification worked. But if I simplify onto the wrong things, then the way I went from a complex world into a simple model is incorrect. It's not adding value. So the first thing I want to say is don't treat those as identical. They are related. And I like in the very next sentence that you combine the ideas of math and art and performance. So that's important because I have to do something with the math. And the guy that's doing something with the math is not just the mathematical robot. If my decision maker is being informed by math, but the decisions that he makes have some emotion and feeling and judgment, I want you to realize the difference between those two things and show how these things and your reaction to results are now, they can be at odds with what the math is telling you. So we got to find a way to blend. In the world of research, we would call that mixed methods. How do I blend this little circle of advisors? So if I'm this decision maker here in the middle, what is my little circle of trust of advisors, and how am I incorporating insights into all these different perspectives in order to make my decision. Well, if I can be efficient and use triangulation, this is like I have two eyes that. Why do raptors have eyes on the front of their head? If you look at the owl, the ultimate predator, he's got these two giant eyes that allow him to focus. Whereas if you look at prey animals, bunny rabbits, they have one eye and they have this wide field of vision. And what they're looking for is sudden motion to get their attention in their peripheral vision. Whereas the owl is trying to pinpoint exactly where that thing is so we can vector in and get him. The binocular vision comes with the cost that everything around him and outside of him he can't see because he's got two eyes on the front of his head, and so in his field of vision he can concentrate, but he can't see any of this stuff. So when we establish a circle of trust, and I'm using math and art and performance and whatever the other skills are, and I'm trying to blend those, I have to learn how to reconcile those different points of view in order to achieve the focus that I want. Whereas if I'm the prey animal, all I have to do is react to surprise and bolt. So two different mindsets. So the hunting mindset that we're using as a trader is always going to have this tension, which you call as the struggle, to correctly assess the market, is now connected to a mindset which says, after I've done the performance art, where I applied the math, and then I look at the results, I think that I can go back to the start point and see what was going on, and I should have been able, now that I see the results, I see what I should have done to correctly have predicted the results that came about. All right, so that is sort of a natural tendency with the brain that we have, which is a pattern matching brain. So of course you want to do that. But the world also says, I'm not going to let you do that because I am so infinitely varied and there are so many exceptions to the rule, and they all look the same leaving the station, that if you are trying to correctly assess the market conditions, then you are always going to be struggling, because that's what you get when you try to control and predict an uncontrollable and an unpredictable system. If you have a system that you're trying to control beyond the limits of the system, like trying to put more precision, it will be a struggle because you're using a false premise, and that is that you can actually predict and control that. So what can I do instead of struggling to correctly assess? Maybe what I can do is appreciate the complexity, and then I can manage it to a satisfactory level, which means that I have to account for the fact that there is signal and noise, and that I only have a certain level of precision that I can get to, that I should expect noise, and I should expect. So if you're in a manufacturing process, which is what I'm trying to teach you here, you have to study what is the normal condition of the system inside the ecosystem that it's in. And that's where we get these different kinds of control charts. And as what is the difference between normal and abnormal? And then what we can have is that we can have rules for what to do for standard work when we're inside normal conditions, and then we want rules for what to do when the market is in abnormal conditions. Well, in this one, we took a trade exactly in the middle of the river, in a sideways river, to which I would say, is that correct? Is that the correct move? And we did that here as well. I say neither one of those are correct, unless I am playing the following pattern. If I have studied the market and I said, this is the normal range and the size of my risk box is here, if I'm inside a normal width, then with my little risk box, the only time I can trade inside there is if it's in a position near the edge where I can see 2 units of reward within the normal channel. Is that why we did that in the middle? If you're in the middle of that box, and you're taking an entry here with your normal size risk box, I want you to recognize that you're only getting half the box and you're trying to squeeze 2 units of reward out of that. And if we said that the size of the box is going to be equal to whatever the statistics told us, do you realize that when you're in that normal condition, you're making it as hard as humanly possible to capture reliable gains? Because your margin of error is so small. So when this thing is in sideways quiet channel under normal width, that is death. That is the very definition of a crocodile river. So there's 2 times when the market slope is sideways. What do I mean by market slope? I mean the slope of the river is flat. It has a certain amplitude. But there's only 2 times that I can trade when this market is sideways and in a channel, meaning that in the last 30 bars, it has not exceeded the narrowest Z3. And I would qualify that as quiet. So if I'm in a normal sideways quiet channel, I can't trade that. But what I can do is I can say, what if the previous move brought it down into, it was some kind of exaggerated move and then pulled back, and now it's at the edge of a Z3, and the PSAR flips. The size of those boxes statistically are a lot bigger than they are up here, and now there's room within the channel for the normal move to unfold. It's at a natural turning point. So what I want is abnormally noisy market conditions. Or I want, the death is up in here. If this is abnormally quiet, then that means this Z3 lines have pinched to an unnaturally narrow position. So now, if I zoom in on that, if they have unnaturally narrowed and my little wrist box is like, and it's sideways, and I'm buying in the middle of the river, because this is so abnormally compressed, what would not be surprising would be if price went like this and now gets into this kind of large amplitude, so the expanding Bollinger Bands are reflecting that things came to a compression and are now leaving the station, and now I've got all this excess. It's in play. So there's two ways that I can start assessing the market now. One of them is, what are the conditions of the last 150 days, 150 bars, and I can go location and volatility. So it's in an abnormal state, and I'm just teaching you sniper trading here. If I set that equal to 100 and this equal to 0, there are 3 locations in which I can say that there is a reasonable move, a reasonably large move that can happen. One is if it's overbought, meaning that it's between 90 and 100, and it's right at a natural resistance limit. And so if this thing breaks out of the last 150 bars, by definition, that is abnormal. Because there were forces in play on the sell side and the buy side, which when they struggled, ended up making this thing stay inside that range for the last 150 days. And now something happened that just caused that, whatever the truth was of the last 150 days, just changed. Now, I don't know what that is, but the normal just changed. That thing could be going. The same thing on the oversold range. Where it's between 0 and 10. It's in the bottom 10% of his range. This one, price came down to that level, and it's either going to rebound back to the normal, the middle of this range, which is at the 50 plus or minus 10. Oops. 64, that should be 40. So in this case, there's a move just to get back to that longer term normal. That is a move that could reward me. This one could have broken out, but it could also fail at the place where it always failed in the last 150 days. I'm not allowed to be surprised if that happens. So just in terms of market condition, by location, I can say, is this one of those times when it is more likely to make an abnormally large move? Yes. By definition, trade location over the last 150 bars gives you a large time frame. It gives you 5 times larger context than the normal 30 bars that we take to make the judgment of the river and the width of the Bollinger Bands and the frog box and all that stuff. So I'm taking a look at the long-term time scale on 150. And now I'm going to do the same thing for 30. So if I'm looking at the 150, and then I'm going to look at the 30, not quite to scale. Now what I got is sort of like a 5-to-1 dial in. I'm going down to the... Now, if that thing is also overbought or oversold, it's at an extreme condition where if there is a break, there's a chance for the kind of big moves that I'm seeing here. And now the same thing on the 10. If I want to fine-tune my execution, so if 30 is my normal math, going out 5 times to 150 and dropping down 1/3 to 10 gives me multiple time frame. So now I'm this little decision maker in the middle, and I'm looking at different time frames to inform my position. And now if I'm looking at the width, how volatile is this? I can go back 100 days and I can classify it as volatile, normal, or quiet, and I'm going to stay out of the normal. And I'm going to say, if it's extremely volatile already, if the last 30 days or 30 bars, which computes the width of the Bollinger Bands and all that, all our statistics is based on that, if this last 30 compared to the last 100, that thin slice compared to the last 100 sets of 30 is volatile, then it's in play. So now I've got the volatility. I want abnormal, volatile, and I want abnormally quiet. I want to stay out of the standard normal because if it's abnormally volatile, it's in play. If it's abnormally quiet, it is so abnormally out of play that it's now potentially in play. It is the coiled spring that has range compression. When I combine both of those things, that location and volatility are both extreme, and I'm going to add in here the middle location. When it's exactly in the middle, the absence of abnormal, it is so absolutely normal that when it breaks out from the 60, it can go 3 units to 90 to become overbought, or 3 units to become oversold. So when it breaks out of there, just a move to normal limits gives me a 3-to-1 reward to risk. So I actually care about when they are so perfectly exactly in the middle of the river. Hey, that's what I see going on inside here. Now my only question is, was there enough room from here to the edge to make my little bet? If this is a normal width, I'm going to say no. But if this was abnormally large because the previous move was so large that the Bollinger... I know it's not the case because the Bollinger Bands are compressing. So this is not as noisy as it was here and was there and was there. I know that's not the case. But if I come down and look at this one where the Bollinger Bands were already expanding, there's enough room inside this thing to get back to Z3 that compared to the size of the box, there's a lot of room in there. And this one is so abnormally quiet that this breakdown here has room to get to Z3, and then if the Z3 collapses, it could be a big move. So when I am trying to assess market conditions, what I just described is not a struggle. It is pure math. And I'm not correctly assessing it unless... I could say I'm correctly assessing it if I applied the mathematics correctly. And it says, yeah, this thing is in an extreme condition, long-term, normal term, and short-term. You know, the 150, the 30, and the 10. Yeah, this thing is at an extreme location on all 3 of those. or 2 out of the 3. You only need actually about 2 out of the 3. The sniper or Godzilla picks those 2, extremely oversold, and then either abnormally volatile or abnormally quiet for volatility, and then you have check Godzilla. So that is not a struggle. That's pure math. And that correctly assesses the market condition. And that tells you on your time frame if that's a symbol that you should be trading. Struggle is done. Now, in the time cycle of some symbol, how often is it inside that optimal window of producing those signals? Well, that's also math. So the struggle occurs when you say, I want to trade this symbol. I want to trade it, but it's in here, so I'm going to try to find a pattern that works. Okay, got it. Or you could say, let me find the symbol when it's in the optimal conditions to run like a scalded ape and trade it there. Okay, well, what do I do when it's not in that condition? You sit on your hands. Well, what do I do when I'm sitting on my hands? Well, I learn to wait, but I also could be like a hunter or a trapper and say, look, I'm going to set up these little traps on this circuit that I walk, and periodically animals that use those trails run through my snare and they get caught, and it takes me all day to check all my traps, and then I just go see if anything got caught in my trap. And sometimes I do, and sometimes I don't. If I catch enough things to feed me, then I have enough traps set. And then as I wander around my territory, I say, oh, there's a trail, and there's an animal that's running through there, and I could set a trap here, and now I can start adding the number of traps that I can set. Or I can be sitting in ambush right here and say, what I'm going to do is when that animal comes into my zone right here, and before he leaves my field of vision, I'm going to catch him right in here with my spear, because I'm going to sit right here and I'm going to get him in that window. But if I don't get him inside my little kill zone, I'm not going to try to chase him because rabbits run faster than me. So this is what a trapper does. This is what a hunter does. A farmer plants seeds and then has to wait for the thing to grow to the sky. Is that the seed that's going to work? I don't know, because they all look the same, but I got a good batch of seeds from plants that, so I got to plant 1,000 seeds, and what is my percent of viability? How many seeds out of 1,000 pay off? I got to know that number. What's that number? When they pay off, how much do they produce? Is the payoff of the ones that produce covering the costs of the ones that don't produce? That is also mathematics. The mindset that it takes to trade like this is different than the trapper, is different than the hunter, is different than wandering around. Hey, I don't want to chase animals. I want to go find berries and roots, and I want to just eat the fruit of existing plants. Well, when do they offer berries? Only at certain times of the year. So I got to go harvest them during harvesting season, which means like this, there's only certain times when I can harvest the fruits and the berries. So market condition is I got to know the seasonality. Well, what kind of instrument do I have that can tell me something about seasonality? Well, how about MACD histogram? Can I find things that are in a harsh winter? And can I find them when they are out of the Red River, which is the normal? If that's the case, this thing is in play. It is running like a scalded ape away from something that's a fear response, and that is usually an overreaction. And then there is some moment when it's in the spring coming back to the zero line, which is what happens before it goes into the summer, which is what happens when it goes into the fall. And so somewhere in here, sometime after the winter has turned to spring, but before it becomes summer, there's kind of an ideal time to plant. Was there really a harsh winter? Was there a harsh winter here? No. Was there a harsh winter here? Not really. Was there a harsh winter there? You bet there was. Right there. Came out of the Red River, crossed into summer, and it did that. So MACD histogram is a way. So now I've given you two models to eliminate the struggle. To correctly describe the market conditions, I can use a sniper mentality of location and volatility of 150, 30, and 10, or I can use the four seasons of MACD and find harsh winters that have turned into springs, and then apply the principles of trade framing. I can also say just but what I want to do, Ken, is I don't want to have 50 symbols on my list and then pick the ones that are ready to trade. What I want to do is I want to specialize in soybeans. Well, if you want to specialize in soybeans, you got to do that first model, because I gave you three models. On the first model, you got to understand on the long term, where is it in its macro cycle? You can actually use the 150 bars for that. And then where is it in my tactical window? Is it after a turning point? Is there a window inside here? What is the amplitude? Does this thing trade like this, where I have periods of rising normal waves, and then periods of abnormal waves, and then periods of sideways quiet waves, and then big? What are the characteristics of soybeans? If you're going to specialize in soybeans, then that means you got to know all the things that all the professionals know about soybeans. What is its, the gap stat, the gain stat, the fail stat, the range stat, the frog box, the the R10. You got to tune the PSAR flips to allow you to get reliable flips with small boxes that lead to longer term trends. You got to know what the average when you go back with the RLFF. Here's another model. You can say there are times when I have a super pinch, when the RL270 and the RL90 and the RL30 and the RL10 have all compressed to within an arbitrarily small box. Maybe that is on daily bars. Maybe that is 1 ATR. That's a reasonable place to start. You may have to go as wide as 2 ATRs so that you get enough opportunities. But you could say, are all four compressed within a certain range? Then that is an acorn. Ready to go. And then the first thing that happens is, at some point, the R10 moves, and then if that is a strong enough move, the R30 breaks out of that thing, and then at some point, the R90 follows, and then at some point, the RL270 breaks out of that. And then there are moments when the R10 no longer is failing, but has moved back a certain distance. And you say, what is that distance? Well, you got to go back and say, on those maximum excursions, how far did they ever get from the RL 270 compared to what I have chosen as the arbitrarily small compression zone? Did this thing, is it 9 ATRs between the long-term fair value and the price? And has that thing moved 2 ATRs off the bottom, meaning that it's a 7 ATR move back to fair value? And I know that it's going to take a certain amount of time for this thing to fight its way back because it climbs up the stairs. Maybe that's enough room to tell me that I have a setup that I can afford to wait for a box of that width with that many opportunities to the upside after it has made a harsh winter, an abnormally large move. So if I'm going to specialize in soybeans, then I got to know things like, how far does this thing move between the RL 270, which is the long-term fair value, and the trader's price, which is the RL 10. So we normally use the 1030 in the RLCO framework. And then if I multiply that by 3, I get 3090. And if I multiply that by 3, I get 9270. So there is a fractal relationship between all of these patterns. These that are fast have a value of 1 compared to the slow one, which is 3 times that. And it turns out that on this time frame, the 30 is the slow one, but if I multiply that by 3, it's now the equivalent of the fast one on the next higher time frame. So if I put those 4 regression lines on my chart, I can now start seeing at a glance what the relationship is between the fair value by long-term buy and holders and short-term traders. Is the difference in those opinions wide enough that when the traders reverse and go back towards long-term fair value, that's a value play? Is there enough room for me to frame that trade? That is not a struggle. That's math to assess the market conditions. So if you want to trade soybeans, now what you got to do is find the time frame that allows you to express the 10, 30, 90, 270 such that the 10 period you can use as price. Is that on 1 minute charts? Is that on monthly charts? Or some points in between? Because this relationship between the 10, 30, 90, and 270 is the same regardless of the time frame. The time frame just tells you how often you're getting a new bar and getting new information to reevaluate. On 1 minute, you're in constant churn. On 1 month, you could track 100,000 symbols and wait for the ones that are in your wheelhouse and then trade them. What do you think a guy that's running billions of dollars does? That's what he does. He identifies all these different segments of the market and then finds things inside each little segment that are in the favorable conditions he wants. He either wants to see something that is so abnormally quiet that he can put a long-term options trade and just play the volatility with a straddle, or he's going to find one that has already been in play and has now begun the reversion to the mean trade after an historically abnormally large sell-off. A value player. So I say all that simply to say when I look at this, and you ask, I have just removed the struggle is not to assess, the struggle is to do the math. That's struggle one, is to set up the math so that it runs that automatically. A robot can do that. That's what TC2000 bundle does, the Ameritrade bundle does, the TradeStation bundle does, my daily reports do. That's what that does, is eliminates the struggle to do math. The second struggle is to convert math into actionable trades. Well, that's what trade framing is. That's not a struggle if you do it professionally, and that is you have an efficient checklist of steps that you do to determine if the trade is qualified. That's answering those standard questions. And you put the visual box trading. I can tell you right here that after this period of quietude and this period of expansion, maybe this is a good trade because this thing is already in play, and now I'm playing a continuation pattern. And I know this one is a great trade because it has gone after a period of an abnormally long PSAR, and it moved, for this box, it moved two of those boxes out, and it went from a harsh winter to the summer. I know that that is a critical state. And if that one works, it's going to look like this. And if it doesn't work, it's going to do this and then quickly fail, and then the size of this move is going to be the size of that move. So that's the trade that I want. None of that was present up in here. The only reason any of those are any good is if that little sideways channel had compressed to such a narrow condition that a breakout from Z3 rewards you. Now, inside that context, all of these entries are right at the Bollinger Band mean. And that's where the crocodiles live. So when you have an abnormally compressed thing, you got to wait for a Z3 breakout. There is a really advanced technique that I shouldn't even show you, which says if you have an abnormally quiet and you decide that you want to just trade right here, you do that with the full knowledge and understanding that you are trading exactly in the middle of the noise and that you're taking half of the channel and that your signal is this and that all of this is frickin' noise. And you make no decisions until where the box pinched gets violated, which means that you are essentially, what you're doing with this one is you are setting up this abnormal pinch box. Says, I am happy to get long here on the Bollinger Band Z3 excursion, or I'm happy to get short here on a violation of the Z3, and I'm going to use the entire width of the box as my risk. And you decided that because of reasons, maybe there was a good long sideways thing like this, and the resistance isn't till it's way up here, and it did this, and you decided, you know what, the trend is so strong when I look back 150 days that I don't mind just buying this now and leave it alone, and then if it comes out of here, I can now raise my stop to no lose plus dinner for two and lock in that piece and consider adding a second position. Why? Because this one earned 2, and now I can use those 2 to fund the place where I was going to break out anyway, but I've used market's money. that is such an advanced technique that you better be a specialist in soybeans if you're going to do that. And then you better know how tightly does this have to pinch for that to happen. If this was a time when soybeans pinched enough in that sideways quiet channel that you were mathematically justified in taking this entry, then that means your stop is right here, and you don't do anything until this thing leaves the Z3. So on that setup, you get one trade. You don't get all these extra trades where you're just PSAR flipping inside the noise. That's the sound of the wind passing by your workshop. If you set that, you forget it until it breaks out of the control box. And then down here, if you put that trade on here because you like the fact that it faked one and went two and then recovered, and you say, you know what, I'm betting downside, so I'm going to take that little trade. Fine. But your stop is here because that's where the Z3 line was. So even this is, that's your risk box right there. And the box where you can add a position is here. And then actually for position sizing, I'd use that whole box. And that whole box in this is only 40 cents. And I know that because I calibrated this. That's 30 cents. And you know why 30 cents is a good box? Because on a super sideways quiet channel, that was the size of the Z3 pinch box. So I'll use 40 cents on this one. And if I'm going to get short here, that trade, I don't do anything until it leaves the station right here. And now I can move my stop from here to here. Check or hold. So if you're going to specialize, then you have to know everything about this thing. Every single thing. A complete medical profile workup. And I've given you 4 different models. 150, 30, 10 with volatility and location. That is the sniper. I've given you the MACD 4 seasons histogram. You got to pick the time frame of decision making, but that's how you do that, and that's if you are a farmer. If you want to be a mechanical rules-based trader, then a trapper, then you have to have like mechanical swing systems, swing trading 1 day at a time, where it's like 5 days down. Oh, that's a tradable pattern. I'm going to put my little snare right there, and I'm going to automatically go long here, and I'm going to automatically go short there, and I expect that thing to move 1, 2, 3 in my favor, and my automatic snare trailing stop with 1R trailing stop just catches it whenever he's done running, and there's my exit. That is mechanical trading as a trapper, and then you got to set enough of those. That's what I'm doing on the hybrid swing, on the 30-minute bars. I'm just setting traps, and you'll notice that the traps that I set look like this one. Extreme sniper traps. Or you can do like a pure sniper, and that is, and say, I have 10 symbols each day that I think are likely to make large moves, and then I sort them by the percent lost, because those are the ones that are most likely the fear move, and then I wait for the SSC. If I want to trap those, I can take the 10 that I framed as a sniper, and as soon as it opens, I can put an MMRB and bracket the open, and then whichever way it goes, trail it with an MMRB and just see how far it runs to the fail stat. So that's 4 different ways in which I'm not trying to predict, but what I did was I assessed the market that it is ripe for the kinds of moves that my trade framing can routinely exploit when it moves with a directional move. And then I gave you the RLFF as a way to rapidly arbitrage the difference between long-term fair value. That's one way to look at the market. And short-term trader's price. That's another way to look at the market. Which one of those guys is right? I don't know, but they have such a big difference of opinion that I can arbitrage the difference on a reversion to the move, because the traders they are under a sense of urgency. Why? Because they're using leverage, and they just made all their money on the big downward move. And now they are motivated sellers because they're trying to preserve the money they made. And when that thing starts moving and their tolerance is over, and yet there's still a large move, then all these guys they say, aha, I knew that. That move was over. I knew they were going to come back to the wagon train. If that all started from an acorn move where they all agreed what the price was and it was abnormally compressed, then you have a perfectly, you have one seed, and now you can plant 1,000 of those and see which one is going to become the oak tree that is going to produce 1 billion seeds over the next 10 years. So that's 4 different ways in which we might apply these principles. And that's everything I want to say. And where I just realized we bled over into the creativity, but that's not going to hurt their feelings much. Let me just ask you to reflect on that, and there was probably several ounces of gold in that one to replay many different times for different pieces and parts. And that should generate, like many acorns, it should generate many more young oak trees full of questions. I'm going to hit the panic button here to end it so it starts the recording. And then I'll fire up the creativity one here shortly. So see you in a few minutes.
Thank you, Ken.